This is a program we call Rippin It. I'm here with Derek Ripp, and we talk about markets, the economy, financial strategies, usually about once a week. Rip, how you doing?
I'm doing well. How about yourself, Kevin?
Doing well. It's another hot Friday, and looking forward to jumping in some water sometime soon. How about you?
Yeah, that's about the only place to be in Texas in the summer is in the water or inside in the air conditioning. Take your pick.
The only thing hotter than the air temperature in Austin, Texas, is the stock market, I think.
Yeah, that's a great transition. Despite a pandemic and a lot of concern for the economy, the stock market is been doing very well the last few months.
Did you drop your Netflix account yesterday? Is that why Netflix is down 7% today?
No, I have to admit that that is a family favorite, and there would be anarchy at the house if from the kids and my wife if I dropped that.
Yeah, well, I think the same here. But that's really what I want to talk about today. Netflix, obviously a great company. Everybody loves Netflix. Is there a price too high to pay for one share of Netflix stock? That's what I want to talk to you about today.
Yeah, and I would say that the reaction for a lot of people is they extrapolate returns. In other words, Netflix is a great company. I think we all agree that they've really kind of pioneered a lot of this, online video. And so the thought is that they will continue to be a great company and stock price will continue to go up. But we know that at some point there is a reversion to the mean. And so, you don't want to be the person buying at the top of that before the pullback. And that's why I think you diversify because nobody really knows how long and how far Netflix and some of these other tech companies are just going to continue to go up.
Yeah, the basic way historically that investors on average have thought about how to price a stock is a simple formula that is when you buy Netflix, you're buying all the future cash flows that Netflix will earn that as a shareholder you will benefit from. So cash flows come from earnings, generally speaking, profits. And the price you're willing to pay for those profits, that's a measure we typically use called price to earnings, which is how expensive or how cheap is a company. Because as a shareholder, you're buying those future earnings. And sometime in about 2018, prices started going up really rapidly and profits kind of flattened out. And we had this gap between what people are paying for stocks and the growth in the earnings. And it's been really dramatic the last 2 years. And right now it's extraordinarily dramatic, particularly in some tech stocks. So I'm wondering what the heck is going on. What is your favorite pet theory as to why some of these price to earnings ratios are exorbitant? I'll just give you one. Shopify, which is a great business that helps companies with online commerce, they're trading at something like, I think it was $60 price to sales, not price to earnings.
Right.
Our business, our company would trade at about 2 times sales. And that's not a fair comparison, really, but just to put it in perspective, Shopify is trading at 60 times price to sales. What's your favorite explanation for this?
I would have to just say that this is human behavior where money will chase performance, and it's a self-fulfilling prophecy, if you will, that because it's done well, it's been continuing to do well, and new dollars continue to chase that. So that's this concept of momentum, right? And we have seen positive price momentum in Shopify and a lot of other tech stocks, Amazon, Netflix, et cetera, where they continue to do well. And that's the $1 million question: is at what point will those price to earnings, price to sales measures come back to reality? and that's what nobody really knows. What we do know is that if you look at some of the historical PE ratios, we are extremely expensive. You know, if I looked at, for example, the Schiller PE ratio, which is just one measurement of PE, the average going back to like 1900 is close to 16 times earnings. We're sitting at, for the S&P right now, a little over 30. And for a lot of these tech companies like Amazon, they're 148 or higher. So we know that it can't go on forever, but we don't know exactly when the party's going to stop.
Let me give you a really, I think, interesting concrete example of how a company can be great, and it can be great for 15 years, and an investor won't necessarily make money. That is a frustrating reality of markets. I'm going to point you to an example. I was looking at this morning. Microsoft. Obviously, Microsoft is on fire. They've had an amazing run the last few years. Great company. They were also a great company in 2000 for different reasons. They were selling all the computers and everybody was running Windows operating systems, and you kind of had to, and they more or less had a lock on the market. In 2000, they were trading at $58 a share. Okay, so that's 20 years ago, $58 a share. In 2016, at the end of 2016, they were trading at $60 a share. 58 to 60, and that's 16 years. Okay, so if you invested in Microsoft in the year 2000 and you held it for 16 years, you basically made no money. That's shocking to me. What's more shocking is that in the year 2000, Microsoft did 23 billion in revenue, and in 2016 they did 91 billion. That's over fourfold, roughly fourfold, 3 or 4-fold growth in revenue in 16 years, and basically zero increase in the share price.
Yeah, you're bringing up a great example, because that is a perfect example of their PE was, if you look at their PE ratio back in 2000, I would wager to bet it was significantly above average. And so you had this reversion to the mean where they caught up, where in other words, their PE ratio came down because their price didn't change, but their earnings grew, right? So that's a classic example that you just went over, to where a company coming back in line with average PE ratios.
I'll give you one more example because it's just too much fun. Coca Cola, okay? Coca Cola, 1998, $43 a share. Okay, at 1990, if you had been invested in Coca Cola for the last 4 years, in 1998, you had tripled your money. You had just tripled your money from 1994 to 1998 in Coca Cola. Okay, again, 1998. Fast forward to today, 2020. The share price is about $46, $47 a share. Again, 1998, it was $43 a share. Today, 46, 47. Basically, no increase in share price. And that's 22 years. This blows my mind. And in 1998, Coca-Cola did 18 billion in revenue, and now they do double that. They do 37 billion. So they doubled. Their profit is almost tripled. They went from 3.5 billion to 9 billion. So the profit's actually grown faster than their revenues. And meanwhile, Coca-Cola, poor Coca-Cola investors, poor saps, didn't make any money. The company got far bigger, made a whole lot more profit, and the investors didn't make a dime.
Yeah, I'm going to blame the millennials for this one. They're all drinking sparkling water now.
Yeah, but funny enough, Coca-Cola probably owns most of those sparkling water companies by now.
Yes, that's true. Again, another example there of how a company gets out ahead of itself in terms of expensiveness and will revert back to the mean. In other words, a more average type of price to earnings ratio. And that's, there's typically a catalyst, or there could be an event or what have you, but the market, a lot of times when the market pulls back, the leadership positions can change as well. And so you had that pullback, in the early 2000, and for a lot of it was, a lot of the expensive names were the high tech, and .com type names that ended up crashing or going out of business. But the market as a whole was expensive at that point, at the peak in 1999. And that's just another example of how these companies will revert and go back to a more historical average price, because when they're so expensive at some point, there's a shift, and your institutional traders and investors will say they don't want to buy it. It's too expensive. They'll go find another company that is going to be the next Coca Cola or be the next Microsoft and have that dramatic growth. And so, that's a challenge with buying individual securities, is where you're buying in that cycle and how expensive the company is.
And it's one thing to identify a great company. That's arguably not that hard to do. There are a lot of great companies, but there's a difference. I think the point we're trying to make, if I could summarize it, is there's a difference between a great company and a great investment, because a great company can be a bad investment for 5, 10, we've seen even 20 years. And what this boils down to is buying great companies at a good price is really your best bet to make money on stocks, in my opinion.
To really, I agree, but to make money on anything, if you're buying a piece of real estate, if you're buying a stock, if you're buying a company, you generally want to buy it at a discount if you can. You will dramatically improve your odds of making a profit if you can buy an asset below its fair market value. And that's the challenge with the market that we're in, is that that has not rewarded investors of late, and really probably for the last decade. If you look at value as an asset class, has underperformed the growth names that we've been talking about in this podcast.
Rip, thanks for the conversation today. It's been cathartic.
happy to have these discussions, and have a great weekend.
You too. Thanks.
Okay.